Reliance is a stock which has moved to the high point of the day, and SBI too helping the cause of the Nifty, now sitting with a gain of about 12-13 points in the green. But the one stock which is sulking in trade today is Tejas Networks, down over 10% in today's trading session on the back of yet another weak quarterly numbers. Previous quarter was bad as well. Revenue came in lower by 20% on a year-on-year basis. So let's see what the management has to say. Mr. Nayak, the MD and CEO of the company, joins us now. Thanks a lot, Mr. Nayak, for joining in. First up, if you could tell us, for the first 9 months, your revenues have declined by about 5.5–6%. You still maintain your 20% growth guidance for this year?
Yes, actually we do. The reason is very simple. The nature of our business is that it's not a quarter-on-quarter business. So if you see actually as a percentage of last year's, we already crossed 82% of our last year's total revenues.
Right.
And we are on a total basis on the 9 month. So we expect a pretty strong Q4. We already have the orders in hand for all the government stuff, which is usually the one which has fluctuations. And all the private and the international run rate customers are all existing customers. On the back of those two, we are very confident that by the time we finish Q4, we'll be around 20% year-on-year.
Just some numbers, Mr. Nayak, because for you to do a 20% growth, you need nearly 300 crores in terms of revenue for the fourth quarter, which is almost a trebling of what you did year-on-year. Last year, fourth quarter, you did revenues of about 100 odd crores. You will triple your revenues in the fourth quarter. Is that what you're saying?
Yes, because last year, as I said, again, the lumpiness is what is really becoming very evident. So quarter on quarter, we will have fluctuations across our revenues, primarily basically because of the government tenders, which can come in big lumps. And this year, since we already have those covered, we don't see that kind of uncertainty at this stage.
So, Mr. Nayak, you're committing that you'll do 290 crores then in the fourth quarter, right?
That is correct.
Absolutely. All right. So we'll hold you on that one. And was there any kind of delay in the third quarter? If you could tell us, was there some part of the order? And you're pretty sure that will come in quarter four, right? Also, in terms of margins, if you could give us a sense, as of this quarter, it's down to sub 20%. So what kind of a number can we work with? Top line, we're bracing ourselves for the 290 crore margins?
Yeah. So there are basically three parts of our business, and let me explain each of them. So the government business, which is based on the tenders, we already have the orders for Q4, and in fact about 300 crores worth of BharatNet Phase 2 tenders, which our system integration partners have already won. Since those orders did not really convert as of date, we basically had a shortage in terms of Q3, and in fact we are not budgeting those in our Q4 numbers for this year. So the government part of the numbers is fine. The India private and the international business is really where the growth significantly is. We are getting a very good traction from our existing customers in India, which is pretty much all the telcos. And internationally, as we had been talking in all the previous conversations, we have been making significant growth. And all the regions that we have been exporting to, we should see a significant growth. Just to give you an overall basis, last year, 82% of our revenues was India and 18% was international. We expect this year to be around 75-25. Which basically means international is going to be growing quite fast. So that's on the revenue side in terms of where the breakup is. And the orders that we are expecting in terms of new orders will really be for next fiscal year revenues. For this year's revenues, we pretty much have all the orders that we need to execute a strong Q4. Coming back to the margins, we are actually ahead of margins in the 9 months. Just as a reference, our 9 months profitability is already crossed the full year profitability of last year. We are about 300 basis points higher in terms of the EBITDA as well as the PAT. Although by the end of the year, we expect it to be around 15% profit after tax or profit before tax compared to previous year's guidance. So we think we are ahead on the game on profitability. Revenues, we have a good sense for Q4, and we are not budgeting any of these government orders for Q4, which basically haven't been lost or anything. They've just been delayed. So that's really where the business stands right now.
Mr. Nayak, we take your point on the profitability as well as the revenue outlook as well. But seems like those profits are perhaps only the ones that you're reporting on your books, because your receivables, they've jumped from almost, 275 crores to 541 crores is the number that we have. Can you confirm what are the receivables on your books and what is the visibility on getting that money back?
Yeah, so if you really look at receivables, when you even talked at the end of Q2, basically there is one particular government customer which has delayed our receivables. So in that sense, it's a customer that we have never had any issues in the past. The payment is related to the BharatNet project, where from our side all the execution issues have been taken care of. There have been internal issues within the organizations in Delhi, for which pretty much payment of all vendors has been delayed, and so was ours. We are very confident those bills are in the system, and by the end of this quarter, we should be able to collect a majority of those payments. By the way, we did collect a significant part last quarter as well, but a large majority is still remaining right now.
What's
the
the
second
amount?
point about the working capital and the DSO days, our DSO days had jumped because of this particular one single customer. And once we collect those things, we should be back into a normal rhythm of around 150 to 145 days of working capital based on the reduced DSO. So I think this should be a quarter where we should be able to bring down the receivables as well, because it's primarily on one customer where, it's a government-related delay, which unfortunately we have not too much control on.
What's the amount that you're talking about that you will receive in the fourth quarter?
I think the total amount from that particular customer is north of 250 crores or somewhere. So we expect to collect a significant part in this quarter. The other is basically routine receivables, which should just come in time.
All right, fair point. Thanks a lot, Mr. Nayak, for joining in and giving us all those details. So that is something that the street will definitely watch out for in the Q4 results. More importantly, the 300 crore top line that you're guiding for is something that we will be watching out for. But from one IT stock to another one, KPIT Tech is the stock on our radar, as the company has listed as an IT services company now, trading X of the engineering business. Reema joins in with more details. Reema.
Hi, thanks so much for that. Yes, so now what you can see on your screen is the IT services business of KPIT plus that of Birlasoft. The engineering business has been hived off and will be listed in the exchanges later. A quick run through of what the numbers look like. Now, so far for the 9 months, KPIT IT plus Birlasoft has revenues of close to about $360 million. This is expected to ramp up to about $460 million by the end of FY19. For FY20, the street estimates are of close to about $500 to $520 million. Margins are seen around that 10 to 10.5% mark, which means the profits for FY20 should be closer to the 300 crore mark, which makes the EPS about 10.5 to 11 times forward. We're talking about FY20 EPS. Now, for the last 10 years or 5 years, KPIT IT has been trading at a forward valuation of about 10 to 11 times, much lower than its peers on account of the volatility in its business as well as execution issues. So right now, if you give it a similar valuation multiple of 10 to 11 times forward PE, then you arrive at a fair price of 105 to 120. If you assign it a higher valuation multiple, then according to analysts, you're pushing up the fair value target to 130, 135. The key to track going ahead will be an improvement in the IT services outlook for this business. Remember, KPIT itself has struggled a tad bit, and even for Birlasoft, there were issues with some of its top clients. And of course, the synergies post the merger with the IT businesses. The engineering business, as we highlighted, will be listed separately. That has been a very strong point of the company. It's seen a revenue growth of nearly 16% for the last 5 years, and that will be listed in March. Back to you.
Okay, all right. Thanks so much for that, Reema. Well, the markets have moved virtually to the high point of the day, courtesy Reliance Industries, the heavyweight fighting rally for the bull.